But shorter term, I mean, if you take a look at how the yield curve is flattened, particularly over the course of the last little while and this big rally in interest rates we've had, the flattening, a lot of it has come actually between the last FOMC meeting, which was on May 1st, and today, right? So I think we're seeing very, very clear evidence the market at least thinks the Federal Reserve is making a policy mistake by potentially cutting too late. And we saw the flattening accelerate in the wake of the FOMC minutes last week. All these pieces of evidence seem to connect it a little bit more clearly to the Federal Reserve rather than trade policy. I mean, trade's sort of an exogenous variable, maybe one thing that influences the Fed, but it really is the perception of the Fed mistake.
I would go back, Guy, and find you a whole bunch of correlations between everything that has happened, the reaction of the bond market, and what's happened to trade. I mean, look what's happened to the 10 years since the president put the tariffs on China. I mean, it's been straight down.
Which, again, coincides relatively closely with the May 1st FOMC meeting, the speeches from Clarita that followed up on that.
That's a stretch to me, Guy, but I'll give it to you.
The power the Federal Reserve has to dominate the shape of the yield curve just overwhelms anything the trade is going to do.
Well, I mean, I can go back to the Monday. There was no FOMC meeting when the 10-year. I don't know if you guys have what was the Monday the Sunday that the president put the tariffs on?
It would have been about 3 weeks ago.
Yeah, it was straight down, and the FOMC wasn't even meeting. So I'm a little surprised, Guy, about but go ahead.
Well, you'll take a look at the shape of the yield curve.
Yeah, the shape of the curve, yeah, but the 10-year is what
from the absolute level
in the wake
of yields.
that. I'm going to have to look it up now.
Guy, let me ask you about that, because to me it's interesting to compare this experience with what happened in 2016. And there's a chart of the 10-year note going back just about the last 30 days or so. You can see in the last couple of weeks there a sharper downdraft. Guy, in 2016, the yield on the U.S. 10-year hit a record low around, and correct me if I'm wrong, 1.375 or so. We're still a good full
right around
percentage
the time of
point.
Brexit.
Yeah, exactly. And we also had German bund yields negative then. What is the big difference between then and now that we're still sitting a percentage point higher than where we were? What does that tell you about our prospects now, if anything?
Well, short-term interest rates have come up roughly 200 basis points since that point, a little bit less than that, actually. And so that's ultimately the Federal Reserve. Again, the trajectory of the Fed funds rate over the course of the next 10 years is the single largest determinant of 10-year Treasury yields. And back to the inverted yield curve, as we started this discussion, essentially what that's telling us is the markets think that the Federal Reserve is going to cut rates. When does the Fed cut rates? One of two circumstances. One, a recession or a significant economic downdraft leading up to one. And two, a really, really big dip in inflation. And they've actually already signaled on the second point that that's not such a big concern right now.
What is so Guy, if what you're saying is that there is a policy mistake here, how is it rectified? What does the Fed need to do to get things, back on the right side here?
Well, to be clear, I'm not saying that there is a policy mistake. I'm saying the markets are starting to price the assumption of one, right? And so essentially the way to fix this in the market's eyes is to cut more aggressively and sooner.
How much?
And there's a lot of themes sort of within market plumbing that also signal that might be necessary as well.
How much are we talking and how quickly?
By how much? Yeah, I suspect that the rate cut that is priced in for 2019, that's a maybe event, but we could see as many as 4 cuts in the year 2020.
So the market is pricing in 4 rate cuts next year, Guy, in order for the bond.
No,
go ahead.
I'm suggesting that's what may likely end up happening. The longer the Fed waits to ease policy, the more they're going to have to ease policy to have the same effect.
Steve, parting thought.
I just looked at the tail of the tape, but I wasn't prepared for what Guy's take was, and the market yields rose after the last Fed meeting. And they have fallen 40 basis points since the president tweeted out about tariffs. And I think there's 2 important things for Powell to consider. One is the cause of this downdraft. Is it his mistake, or is it something else exogenous? And I think second, he has to figure out if he should react to it, and if he does react, will it have any effect? And I'm not sure that if the problem is trade, cutting rates is the solution, because the initial impulse of tariffs is higher prices. It may be weaker growth on the back end of that, but it's going to be a little weird to be cutting rates at 3.6% unemployment with tariffs potentially on another $325 billion of goods coming into the system and having the Fed cutting interest rates. I don't think that's exactly what the manual says.